today. I'm going to share my screen. And we can get started. So today we're going to be talking about foundations for funding for startups. Before we do, just briefly, my background, I've been a serial entrepreneur. I'm a venture partner in a seed stage venture capital fund called Urban Us, and a startup attorney where I'm the founder and co-chair of Next Powered by Shulman Rogers. Next is an innovative new model for delivering legal services to startup and emerging growth companies. We offer predictable legal fees through more than 75 fixed price packages, as well as a number of custom packages that we do. Our clients get to work directly with senior attorneys through a high touch, hands-on delivery model. And we integrate technology to make the experience much more transparent, collaborative, and efficient. And for more information on Next, you can visit us at www.next.law. So the first place to start in fundraising for as an early stage or seed stage startup company is to have your fund investor package ready. So you're going to prepare a one-page summary. You're going to prepare a pitch deck, and with your pitch deck, the key is practice, practice, practice. You can never practice your pitch too much. And every time you give a pitch, you come back, you learn from what questions were asked that you maybe didn't have covered in your pitch and what didn't work well, and you iterate and learn and adjust your pitch after each investor meeting. You have an executive summary, a financial model. The key in the financial model is not so much that the numbers are going to all plan out exactly, but that you really understand your assumptions and you're able to demonstrate to the investor that the granular assumptions that drive your business model are clear to you. And so that's an important part of the financial model. And then you should have a non-disclosure agreement. Strategic and angel investors will usually sign a non-disclosure agreement. VC funds, particularly the larger VC funds, usually will not. But it's important to have that as another piece of your investor package that you have ready. When it comes to investors, choose your early investors very carefully if you have the ability to do so. Early investors become a key part and an important partner in the success of your startup. And even the most successful startups go through periods of time where they hit a rough patch, where they're running out of money, where pivot is required, and having the support of your early stage investors becomes really critical during those phases of growth. When you're looking for investors, try to find investors whose sweet spot, meaning the stage of investment, the market segment, geography, other areas that they've identified that are important to them match where you are. You'll find that investor meetings are very challenging when you're not in that sweet spot where your investors like to invest. So spend time to do research and to understand where the investors want to be and to participate and to find people and pitch to people in that area. It's also helpful early on to have a few key investors, one of whom may be willing during one of these periods where things are a little bit slower or rougher from a cash raising point of view, and you need somebody to step up to help bridge to the next round. Having some of those early key investors is really important. And remember with your investors to keep them well informed of everything that's happening with your business. You never want to surprise investors. You want them to be along with you in knowing how the business is doing, not only the great news, but the challenges as well. In terms of seed stage investing, the way you get investment from, and the typical investors in this early stage are either the founders are funding, so it's self-funded. You're getting funding from friends and family, from angels or institutional angels. People are more often now doing crowdfunding, especially with the new crowdfunding rules, which allow for a larger amount of capital to be raised through crowdfunding platforms. You have seed stage VCs. These are VC investors who focus on seed stage, and strategic investors. So those tend to be the groups of people who invest in the seed stage. What you're trying to do with that capital is complete all your corporate formation related objectives. You're building a product or service offering. You may be adding your first employees and adding to your contractors. And validation, you're demonstrating product market fit and some early customer success. So those become some of the objectives that you're seeking to do. And then in terms of the legal side, the securities that you'll be issuing will either be common stock, which is voting or non-voting, and that's the voting common stock is usually what founders get. You may have a safe or a simple agreement for future equity, convertible notes, Series Seed preferred stock, which is a priced round of funding, sometimes referred to as Series AA preferred stock, and warrants. And we'll talk in more detail about these different securities. So once you've kind of identified and started talking to investors, one of the things that's going to come up is going to be a term sheet. It's usually the first document that's prepared and negotiated, and it highlights the key terms of the transaction. The good thing about a term sheet is it forces early identification of key deal terms, which also means early identification of deal breakers. So you don't end up going through a very long process with investors only to find out there were certain deal terms that absolutely were deal breakers that you could have found out about from early on. Also, once you have a term sheet, it makes drafting the definitive documents much more efficient and effective, and reduces the overall time and expense in a deal, investing in the time up front on the term sheet. Term sheets are generally non-binding. You may have some binding provisions, like there may be a confidentiality provision put in. Investors may try to put in an exclusivity period. If you have those binding provisions, you need to have a governing law to govern those binding provisions. And sometimes people will address expenses from this kind of early part of the transaction as to who's responsible. Like, for instance, each party is responsible for their own expenses. For the seed round securities, the first one we're going to talk about is a convertible note. The convertible note is a debt instrument with interest that usually accrues. The reason for a convertible note is that it bypasses the need for an upfront agreement on the priced valuation, the current valuation of the company. You will have a cap often, which we'll talk about, but that's still not the price. You're putting a price on the round. And this is really helpful because at this early stage, the entrepreneur sees all of the upside and potential of their business. It's still either an idea or an idea with a minimum viable product or an idea with an early stage product and some early customers, but not a lot of revenue. So there's still a lot that's unknown. There's still a lot of risk from the investor's perspective. There's still execution risk. There's technology or product risk. There's market risk. There's capital risk. So how do two different groups, one who's seeing all the upside and potential and one who's also looking at all the risks, come to agreement on valuation? Very hard to do. So again, the convertible note and the safe, like the convertible note, are a solution to that. So key terms of a convertible note: you have an interest rate that is usually accrued and added to principal on conversion. You have a term or a maturity date. So for instance, like a 2-year note. You have a discount rate. So the discount that the investors get when the next round is, when your priced round is closed. So like a 20% discount is often used. The cap, which is the maximum value the investor will pay, will come in at, the valuation they'll come in at on conversion. And then there are the different conversion terms, when there's automatic conversion, when there's on a qualified financing or next equity financing, what happens when you sell the company in terms of conversion, if you sell before you raise a round, what happens if you hit the maturity date before you've sold the company or raised a round. So all these things get addressed then. It's usually unsecured, but sometimes it can be secured. And like I said before, it converts into the company's equity either automatically, voluntarily, when there's a corporate transaction like the sale of the company or maturity date. And it has priority over common and preferred shareholders. The cap is a really important concept to understand what it means and how it works. It shows up in safes and convertible notes very often. It's there to provide some additional protection to the investors in the event that they put their capital in and the company just hits it out of the ballpark and is growing tremendously and has added a lot of value on the money that they got from the convertible note holder or safe investor, convertible note holder or safe investor. And those investors feel like they should, for the risk they've taken early on, not just get the benefit of the 20% discount, but also have a cap. So in this example, the company has 1 million shares of common stock. They issued a $500,000 convertible note with a 20% discount and a valuation cap of $5 million. The company subsequently is able to raise money at a pre-money valuation of $10 million in its next priced round. So for those new investors who come in, and if there was no cap or discount, the valuation is $10 million. If you have 1 million shares outstanding, it's $10 a share. And if you invest $500,000, you get 50,000 shares. If the investor uses their 20% discount, a 20% discount on 10 million is 8 million. So it's $8 a share. And for that $500,000 investment, they get 62,500 shares. But with the cap, it means they convert at not higher than a $5 million valuation, which is $5 a share. So they get 100,000 shares. So you can see no cap or discount, 50,000, 20% discount, 62,500. The 5 million cap, they get 100,000 shares. So in this particular instance, the way these are set up, the investor chooses whichever one is better for them, the discount or the cap. They would definitely pick the cap. But it's important as a founder to understand how the cap works and how it impacts you. A safe or simple agreement for future equity also has a discount rate and a cap. But unlike a convertible note, there's no interest or maturity date. It converts to in the next equity financing, the same way as a convertible note converts at either the discount or the cap. If there's a sale of a company, the convertible, the safe holder can receive back some multiple of their investment, like 1 times their investment, or they can convert to common stock and participate in the proceeds of that corporate transaction. They have no rights as a stockholder until conversion, although some safes could provide for dividend rights. And like the convertible note holders, they have priority over the common and the preferred shareholders. The last security we'll touch on is a warrant. A warrant is a derivative that confers the right but not the obligation to buy what is normally equity at a price before expiration. It is used as additional incentive to an investor for maybe moving first or moving quickly in a financing, or to a strategic partner tied to a strategic transaction where you want to give them a kicker to that transaction in the form of some equity. So a warrant gives the investor to purchase, for instance, in this example, 50,000 shares. They get to purchase those shares at an exercise price that's determined in the warrant, like $2 a share, for instance, or however it's calculated. They have a period of time they could exercise that warrant. So if the warrant's exercise price is $2, in this particular case, if it's a 5-year warrant, they can wait for those shares to be worth more than $2, maybe $10 before they exercise. And you can have a cashless exercise if the warrant gives that permission, where they just get the difference between their exercise price and the share price. For preferred stock in a priced round, which is the last form of security that you may see in a seed financing or seed stage startup company. This is when you actually go ahead and you price your shares, and these are called Series Seed preferred stock, sometimes referred to as Series AA. And this is actual equity today in the company. It comes with certain rights and preferences over the common stock. And it has protective provisions as well, sometimes to address the fact that the investors only own a minority interest in the company. And we'll talk about all of these. When you are negotiating with your investors in a seed financing, you're negotiating over these three areas, three key levers in the negotiation: the value of the company, which drives the percent of the company you're selling in the financing. So this is priced round in equity financing. You're negotiating over those investor rights and preferences that I mentioned, which drive the investors' preferences with respect to distributions of profit or distributions upon a liquidity event, as well as rights to participate in new issuances and transfers of issued securities. And then there's the control provisions or the protective provisions, where they drive the level of control an investor who usually owns a minority interest in the company can exert on major actions of the company as a shareholder through their board seats. And again, we'll go into more detail of these. In terms of the value of the company, the key valuation concepts to understand are pre-money versus post-money valuation and what that means, and if a share price is being calculated on a fully diluted basis and what that means to you as the founder. Pre-money valuation is the valuation that does not include the new cash that is being raised. The post-money valuation is the valuation of the company that includes the new cash to be raised. So if you have an entrepreneur who's raising $500,000 and the investor and the entrepreneur agree on a valuation of $2 million, the question is the $2 million a pre-money or a post-money? And it's important to know what the investor is asking for. If it was pre-money, the business is actually worth $2.5 million after the closing of the $500,000. And the investor receives 20% or 500,000 divided by 2.5 million of the company at closing. But if it's a post-money, then the business is worth 2 million after the 500,000 comes in, which means it was worth 1.5 before in its pre-money, and the investor receives 25% of the company upon closing. So you can see, same investment, 500,000, valuation agreed on to be 2 million, but whether it's hit pre or post determines whether the investor gets 20% or 25%. It's also important in a post-money valuation scenario for the founder to understand that if they raise more money, what's going to happen is it's just going to dilute the founder even more, because the valuation post-money does not go up. So if this entrepreneur brought in $1 million instead of 500,000, they were oversubscribed and decided to bring in $1 million, the pre-money value gets reduced to 1 million from 1.5 because it has to stay at the 2 million post valuation. And so that's just another really important thing to understand as a founder in whether you're talking about pre or post, and the risk to the founder in a post-money scenario if you raise more than what you plan to raise. The next thing we're going to talk about is the fully diluted basis calculation. So when you calculate a share price, the way you do it is you take the value of the company and you divide it by the number of shares. The question is, what is included in that number of shares? Is it shares that are issued and outstanding only? Do you include shares in the stock option plan that have been reserved but never been granted? Or if they've been granted, they've never been exercised, and they may never actually become shares issued and outstanding. The same with the warrants. Do you include warrants that have been issued and granted but not exercised and may never become issued and outstanding shares? Because remember, the larger the denominator, meaning the more of those that get included in the denominator, the lower the share price, and for the same investment, the more equity the investor is going to get. So in a fully diluted basis calculation, you include all of those, the issued and outstanding, everything in the stock option plan, all warrants, all get included in that denominator. And investors will almost always require the share price to be calculated on a fully diluted basis. So just to see an example of that, shares issued and outstanding are 2 million. The stock option plan is 500,000. These have never been granted, and the investor invests 500,000 at a $2 million pre-money valuation. So if you were only basing this on shares issued and outstanding, you would have 2 million shares and $2 million value. So it's a dollar share price. And the number of shares issued in the financing would be the $500,000 divided by the dollar share price is 500,000 shares. But if you look at it on a fully diluted basis, you include the 500,000 stock options in the denominator. So the share price actually gets reduced from $1 a share to 80 cents a share. The pre-money valuation didn't change. It's still 2 million. But because the investors are asking you to include all of these options in the denominator, in the fully diluted basis calculation, the share price drops, and the investors for their $500,000 investment get 625,000 shares. So big deal for you to plan on fully diluted, and to know when you're giving a valuation, you've calculated it on a fully diluted basis before. Then for the rights and preferences, you'll be negotiating with investors over rights and preferences. Now, in a typical Series seed round, there'll be fewer rights and preferences that you'll probably end up giving than in a Series A financing. So of this list, where there's liquidation preferences and preemptive rights and information rights and drag-along rights and anti-dilution rights and dividend rights and rights of first refusal and redemption rights and registration rights and rights to board seats. These are all rights that the investors are going to spend time negotiating. You as a founder need to kind of understand them, understand what's typical in a Series seed financing versus a Series A financing. So let's just understand what some of these are. The liquidation preference is a way for the investor to recoup their original investment or a multiple of it before there's any distributions to the common stockholders, and it provides downside protection to the investors. It normally occurs upon some type of liquidation event or dissolution or merger or sale of the company. So if the investor invests $1 million and they have a 1x liquidation preference, they can get $1 million back before the shareholder gets their first dollar. If it's a 2x liquidation preference, they get $2 million back before the investor gets their first dollar. Now, the way that fits in terms of when they trigger that is in most term sheets, you're going to see that either there's something that describes the liquidation preference as a non-participating preferred share or a participating preferred. In a non-participating preferred, the investor can either get back their liquidation preference, which is 1x their investment, or they can convert to common stock, take their percent or be deemed to convert, get their percentage ownership based on that. So if they own 20% of the equity, 20% of the proceeds, and they can participate in the proceeds of the sales. If a business was sold for $10 million and they own 20%, they can get $2 million. If they get their money back and it's a one-time liquidation preference on a 1 million investment, they get 1. So they're going to choose, do I want 1 million or 2 million? They're going to choose 2 million and they're going to pick door 2. In participating preferred, the investor is saying, I actually want both doors. I want to go in and get my liquidation preference in our example of 1 million. And then I want to go through door 2 and get my 2 million from owning 20% of the company. So I'm going to get a total of 3 million instead of 1 or 2. And so it's important to know whether what you've negotiated for in terms of the investor is participating preferred or non-participating preferred. Preemptive rights protect the investor against dilution from future financings by basically saying to the investor, whatever percentage you own in the company before the round, you get to invest that portion of the round, which keeps you in the same percentage ownership after the round. So if you own 20% of the company before, and we're raising $1 million, you can take 200,000 of it, which will keep you at 20% after the round. This is a very common right that investors will ask for. You just need to understand the impact on future rounds. If you do a later round and an investor wants to take 70 or 80 or 90% of the round, your new investor, and you've already given preemptive rights to people who own 30 and a new investor wants 80, somebody has to give in. Either the new investor has to cut back to 70 or the old investors have to agree to waive some of their preemptive rights down from 30 to 20%. So it requires that type of negotiation and understanding from your prior investors that that's something that's important for them to do. And often this preemptive right for that reason is limited to major investors. So if you have to go back and get waivers, you're dealing with larger investors who are used to investing in these types of early stage companies who understand that. And also you're not going to every single investor to negotiate that right if you've given it, even the very small ones, if you've given this right to everyone. Information rights are the right to financial information such as income statements, balance sheets, and cash flow statements on a unaudited or audited financial. Early stage, it's almost always unaudited. Could be on an annual, quarterly, or monthly basis. That's part of what you'll negotiate with investors over. And what you're weighing with investors is, and the management team is, you want to keep investors informed. It's really important for them to get information on the company. But from a legal obligation point of view, in terms of if you didn't meet these, you would be in breach. How much detail do you want to give? Do you also want to give budgets and key financial metrics? Do you want it to be monthly instead of quarterly? So you may also give different information rights to major investors versus smaller investors who get some information rights, but not necessarily the full information rights that a major investor is getting. But that's where the negotiation happens over frequency and extensiveness of information. Drag-along rights, these are the rights if a certain number of investors vote to sell the company and the board votes to sell the company, for instance, majority of the board, including maybe the preferred shareholder, the major shareholders or the holders of a majority in interest, then everybody has to agree to sell. So it prevents the ability of a small number of investors or investors who hold a small percentage interest holding up the sale because they don't like the terms and they own 5% of the company and they refuse to sell. And the buyer will only buy if they can acquire everything. So drag-along rights provide protection that investors want to see in place, and it's good for the founders as well. Anti-dilution protection, this is protection against the down round. So you raise money at $2 in your preferred seed round, and then the next round is $1. The different types of protections that get put into these agreements, they could be full ratchet, where it takes into account only the fact that you raised money at $1 down from $2, and you make adjustments to the conversion from preferred to common so that the investors are treated as if all their investments that they put in at $2 came in at $1. You have broad-based weighted average, which is the most frequently used and the most favorable to founders, where you take into account not only the fact that you raised money at $1, but also how many shares you raised at $1 and what percent of the company did those shares represent. So it creates a ratio that takes into account the volume of shares that was sold, not just the price that it was sold at. So that's what makes it more favorable to founders than a full ratchet. Narrow-based is not used as often, and that just looks at the shares outstanding when you're looking at the percentage that was sold, not looking at shares on a fully diluted basis. So another important clause to understand. With the protective provisions, they're going to be more extensive in a Series A versus a Series C or AA financing, but it provides investors who control less than 50% of the shares and less than 50% of the board seats with approval rights over major decisions that or actions that the company could be taking. So some of these types of actions, now a lot of these will show up in Series A, and in Series C preferred stock, you may negotiate some of these away and some may be included, but the examples of the types of protective provisions that are out there are you can't, without approval of the preferred shareholders and the preferred share director, or amend the certificate of the bylaws, or repurchase or redeem equity, or have a major material change to the company's business, or change in the size of the board, or issuing new equity or securities convertible into equity like safes or convertible notes, hiring and firing key employees or changing their compensation, incurring debt above a certain amount, selling the company, or liquidating or dissolving and winding up the company. So all these terms that all of these decisions that are part of building and growing the business get negotiated as to which of these actions, in essence, the investors have a veto right over. And so important to understand these, important to spend time with your lawyer as you negotiate through these with investors. Again, these tend to be more extensive in Series A than Series AA or C, but they will show up in some of your negotiations, so it's important to understand them. Once you're done with the term sheet, the investor gets into due diligence. You have business due diligence, financial due diligence, and legal due diligence. For the legal due diligence, the investors are going to be looking at your corporate structure, how the company was formed. Is it qualified to do business where it's doing business? Did the founders get their stock in a documented way? So they're going to look at they're going to look at the bylaws and the certificates, and is the company in good standing? The cap table, they want to look in detail at everything that's on the cap table that should be reflected, the safes, the convertible notes, any prior common stock that was issued, including to the founders, the equity incentive plan, and they want to see again that everything is documented correctly. The team, they're going to look and see who's on the team. They're going to look and see if people have signed proprietary information and invention assignment agreements to protect the intellectual property and confidential information of the company. They're going to look to see if there's vesting shares for the founders, so that if one founder leaves, that founder doesn't leave with half the company. They're going to look at whether there's non-solicitation and non-disparagement and other types of restrictive covenants. They're going to look at your material agreements that you may have with customers. They're going to look at intellectual property. So have you filed for any patents or trademarks or trade names? Is there any trade secrets? Do you have provisional patents that have been filed for? Do you have any patents that are approved? And then on the regulatory side, they're going to look and see, have you complied when you raised early money with SEC and state securities laws, and also whether there's any litigation risk. This process is one of those processes you can prepare for. You know it's coming. If you're going to be raising money, you should have all your documents organized in Box or another type of online folder system, a data room system where everything is marked and everything is tagged, and you have it matching a due diligence list. You have had attorneys review all your documents. If you haven't been working with attorneys all the way along to make sure everything is correct, that there aren't going to be problems that are identified by the investors when they look at the documents. You have time up front to get them corrected if things need to be corrected, because this process is either going to leave the investor feeling very confident in the company and the management team because of how smoothly it's gone, or if it's not going smoothly and there's a lot of problems, it's going to raise red flags as to, if these are all the problems I uncovered during due diligence, what are the problems that I didn't find? So those become red flags. As far as the definitive documents for a convertible note, you're going to sign a note purchase agreement and then the actual convertible note. Sometimes these are combined. You're going to have the simple agreement for future equity, or the SAFE agreement. And in the Series AA or Series C preferred stock, you're going to have a stock purchase agreement, an amended and restated certificate, and an amended and restated stockholder agreement. And sometimes that stockholder agreement is broken down into investor rights agreement, a right of first refusal, and co-sale agreement, and a voting agreement. So you take that one agreement and it gets broken down into those three agreements. And then for regulatory compliance, every time you raise money, the ability to raise money is regulated by the Securities Act of 1933 and state security laws. Under Section 5, all issuers, which is you, the company, the founders in the company issuing stock, must register non-exempt securities with the SEC. That's very expensive and very time-consuming. So you look for an exemption. 4A2 says that registration does not apply if it's a transaction by an issuer not involving any public offering, and there are different types of cases and precedent as to how to interpret that. And then there's the safe harbor, where most of these private deals happen, these early stage financing deals happen under Rule 506 of Regulation D. You may have heard of people talking about Reg D or 506, 506B or 506C. 506B and C are safe harbors for issuers to meet these private placement exemption rules. Under 506B, you cannot broadly solicit or generally advertise. Under 506C, you can broadly solicit and generally advertise, but they're very strict third-party accredited investor verification rules that you have to follow. You then file with the SEC, a Reg D filing, a Form D, and you also have to look in every state where investors reside to see if there are requirements at the state level in terms of security filings within that state. So that kind of completes the presentation part of today's session. My contact information is on the screen. Feel free, if you didn't ask questions in the session that we're about to go into, or want a copy of today's presentation, you can just email me at amillen@shulmanrogers.com, and I'm happy to share it with you. Or you can reach out to Next or to me on LinkedIn. With that, Corey, I'm going to stop sharing and just see we have some time now to answer any questions on what we've discussed today.
Okay, great. Yeah, if you have any questions for Anthony, you can either come off mute or you can put them here in the chat, and Anthony will have some time now to answer questions.
I know there was a kind of a lot of information covered. These become very, very important concepts. So I see a question here. Yes, so in terms of conversations with investors, I think that it is important to, if you haven't been through the process before, investors have been through the process over and over again. So having an understanding of the process, that expert can be kind of a business advisor who you have a relationship with, or very importantly, as you can see, having from the very early stages a legal advisor who can work with you in those conversations and strategy and approach and discussions with investors and negotiations with investors becomes important. So I do think that bringing somebody on early is really helpful. Similar question just for early stage startups in a pre-seed angel round. I think if you're able to find a lawyer who specializes in working with startup companies and can help you even in the pre-seed angel round, that is helpful to help you figure out whether you should do this as a safe, whether it should be a convertible note. Are you negotiating with friends and family? What should a cap be? Should you be giving people the benefit of a cap? You have to, even if it's an angel round with friends and family, you may need to do security filings with the SEC to be in compliance with the Security and Exchange Commission and with state levels. So the answer is, it's important to try to find a lawyer who kind of can work with you, who understands the cash constraints of the early stage startup company, who understands and helps you prioritize what aspect of this to focus on, which things maybe can wait till you've closed your angel round, which things you should have somebody engaged with you during the angel round. So that my kind of recommendation always be, yes, if you're able to find somebody who you can work with, who can work with startups and understands the space very well, you're always going to be in a better position even for pre-seed. In terms of suggestions for firms that that can work with you on pre-seed, you're always welcome to take a look. Next.law, we specialize and only in the next part of our business, we work with startup and emerging growth companies around the country. But if you do a search for startup and startup lawyers or lawyers who can work with startup companies, you'll probably get some others. But the key is not understanding how to work with startups, to work at the pace that startups work, to kind of be able to work within the cost structure of startups, and to understand how to prioritize, because in a perfect world, you get all of these different services, but you're trying to build your product. You also need to work with an accountant. You're trying to bring on some employees. You're trying to spend some money on marketing. You have the legal expenses. As a startup company, as I mentioned, I've been through this a few times as a serial entrepreneur. You can't do everything. And so also having somebody who doesn't just say, yes, it's all important, but can kind of help you figure out where to target your limited investment dollars early on, and then where to expand from there is really important. And understanding startups is really important. There's a question on how can a startup afford lawyer fees before getting funded. Like I said before, there are lawyers who have different ways of working with startup companies, and you may have to put some dollars into it. So as when you're starting a company, even during the early days, you're going to have some budget. It's not going to be a large budget, and you're going to have to prioritize where you spend that budget. But my view is if you don't cover some of the really critical aspects of the financing or legal work, it becomes much more expensive and problematic to fix later. So I don't think there are some places where there's different programs that are out there for startup companies to get some different types of guidance, but there are options out there where you can have affordable legal services during some of these early stages. You're not going to have a budget for everything, but it costs you much more and much riskier to go into raising a round of financing without any help. Any other questions on either safes or convertible notes? On one of the other areas that we touched on is we've touched on a few different types of instruments. When should one suggest a convertible note versus a safe? So when the difference, both a convertible note and a safe, you're not finalizing that, you're not valuing the company. You could put a discount or what's called the cap, which we spoke about, but both of those instruments are helpful securities for situations when you can't agree on a valuation. Now, the difference between a convertible note and a safe is the safe is the most favorable security for raising seed stage funding for founders. The two key differences between a convertible note and a safe is the safe does not have a maturity date and it does not have interest rates. So one of where the safe came from is with convertible notes, you often have, let's just say, a 2-year maturity date, you raise $1 million or $1.5 million in your convertible note, and then the 2 years comes up, and in most instances, the founder does not have $1.5 million sitting around if they haven't raised another round of funding to repay that convertible note, is what often happens. So you have a few things happen at that point. Either you're progressing with your company and you renegotiate with your convertible note holders to extend the maturity date, let's just say another year, or you negotiate to convert everybody into equity at that point. Or the company is at risk of failing because it does not have the 1.5. What a safe does is it recognizes that even when people are investing in convertible notes, these are very low interest rate, high risk securities. People are investing because of the potential upside, because of the equity value and the ability to convert to equity. So these tend to be more equity oriented securities than traditional debt oriented securities. And so what a safe did is it looks at those issues around convertible notes and maturity date with interest, and it just eliminates them. And so if you hold a safe, you hold that safe until until the company raises a qualified round of financing where the note converts, or a non-qualified round where you have the option, the safe converts, where the safe has the option to convert, or the company is sold and you have an ability to either get your money back or to sell. So that becomes the big difference. It's also less paperwork, less to negotiate for a safe. So it's become very popular instrument in raising early stage capital. The other thing I would just say and talk just for a few more minutes about is from the beginning, as you're preparing for early stage funding, it is really important to be organized and to have kind of everything in place. And we've kind of gone through today a list of all of the different types of documents that you're going to need from both a business perspective in terms of the pitch deck and the financial model. And we've kind of gone through what you need to do to practice that. And we've gone through what you need to do to in terms of the legal documents that you'd like to have and need to have ready. And I highly recommend spending time getting up to, getting all of that in place and ready ahead of the process, because you don't want to slow the process down by not having that all ready to go. We just have a few minutes left. Is there anything else that people would like to cover today in terms of questions? All right, then the last thing I'm going to talk about, if there are no more questions, is just, it looked like one more question was just coming in. Hold on one second. What resources would you suggest to prepare for the paperwork? So in terms of paperwork, okay, so what resources do you want to prepare? So the most important things you want to have in place when the most common mistakes that founders make early on, number one, in that you want to have documents prepared for. Number one, if there are multiple founders, you want to consider having shares that vest, because when one founder leaves, 6 months into a venture with 30 or 50% of the company, that ends up being a very challenging situation. And we often faced with that, where clients come to us and are trying to figure out how to deal with that issue, because the founders that are staying are working 24 hours a day, 7 days a week, building this company, and there's somebody who left who isn't anymore. Another area that comes up early on that's really important is to make sure every one of the founders is very aligned going into the business as to how fast the business is going to grow, the culture of the business that you want to build, you want to be able to make sure you're agreeing that you're going to or not going to take outside capital, how much you prepared to raise in outside capital, the speed within which you're going to do it, the speed within which you're going to scale. So that's another area where we see a lot of issues. Another area is companies that start building and don't protect their name of their business or the name of their product, and start building goodwill and spending time and money building that, and then find that they did not protect it, and somebody comes out and as they start growing and becoming successful and requires that they switch their name. So that's another thing that's important to focus on early on. Another thing that's important is getting all of the consultants and independent contractors and employees who are working with you to sign documents where all of the intellectual property for what they're working on belong to you, the company, and that you protect confidential information. Investors are going to ask for that, and to see those documents when they get ready to when they're doing due diligence. And it's very hard to chase people down after they've left the company if they never signed that ahead of time. So that is another really important thing to get right at the beginning. And then I think it's also important to make sure you're classifying employees and independent contractors correctly, to make sure you're in compliance of employment laws. And also, like I said before, if you've raised any friends and family money before, that you have done your security filings, because investors are going to come in and want to see evidence of those security filings from any money that you've raised in the past. So those are just some kind of common mistakes that early seed stage companies may make going into this process. And with that, Corey, I will hand it back to you. We just have, I think, like a minute or two left.
Okay, great. Thank you so much, Anthony, for an amazing talk here on foundations of funding for early stage startups. And again, thank you so much to Next, powered by Shulman Rogers, the future of startup law, for sponsoring DC Startup Week, one of our title sponsors with Hunt Club this week. Really appreciate the support of our community. Couldn't have done this without you.
Well, we are so honored to be a sponsor and to support DC Startup Week. As I said early on when the week first started, we really believe this is one of the most impactful and important weeks in bringing entrepreneurs and investors and all the other stakeholders together across our ecosystem, in the startup ecosystem in the DC region. So thank you to all of you guys, Seema and Corey and Rachel and their whole team, who have made this incredible week happen.